Okay, let's unpack this.
Yeah.
We are opening a forensic file today. And the subject, it's not some big dramatic stock market crash you see on the news.
No, not at all. It's something, well, something far more insidious.
Exactly. The private credit bubble. We're treating this as a genuine systemic threat.
Like a hidden crash
A
almost.
hidden crash, that's the perfect term. One that's happening in, slow motion, completely outside of where the traditional regulators are even looking.
And that framing is so essential because when you, the average person, think of financial risk, your eyes go to the stock market, right? Or the big regulated banks.
The usual suspects.
The usual suspects. But our mission today is to really pull back that curtain on the, what is it, a $1.7 trillion unregulated debt market.
A monstrous sum.
It's a monstrous sum that has just grown exponentially, entirely in the shadows. And we want to trace the path of exactly how the massive, opaque risks that were generated there have been transferred directly onto you, onto your retirement funds, your insurance reserves.
The core thesis we are pursuing here, and it's based on all the sources we've examined, is that the next 2008-style crisis, it's not happening on Wall Street where the lights are on.
Mm-hmm.
It's happening in this realm we're calling the Wild West of finance, where debt has been leveraged to these incredibly dangerous levels, losses have been hidden through some, frankly, shocking accounting, and the bill for this entire enterprise is set to come due very, very soon.
So to conduct this investigation properly, we have to start by defining the landscape. I mean, what exactly is private credit?
Right. Start there.
Simply put, it's the shadow banking system. After the 2008 crisis, you had these massive investment firms, your hedge funds, the private equity giants. They saw a huge opportunity.
An opening in the market.
A massive opening. They stepped in to become the lenders themselves, issuing loans directly to businesses that the regulated traditional banks explicitly refused to touch.
And that distinction is just so crucial.
Hmm.
A regulated bank, they're constrained by public safety rules, capital requirements, intense regulatory scrutiny.
Right.
These shadow lenders operate with essentially none of that.
That's the key. The regulated system, for all its faults, has become safer. But the demand for risky, highly leveraged financing, that never went away.
Of course not.
And this market just exploded.
Yeah.
Our sources indicate it grew from almost nothing after 2008 to this current, $1.7 trillion valuation.
And that staggering expansion, it wasn't an accident. It's a direct, almost intended consequence of regulatory policy.
It is. Let's talk about that consequence, what we're calling the shadow shift.
Okay.
After 2008, you had regulations like Dodd-Frank come in. They required the public banks to hold way more capital, to adhere to much stricter lending standards. And it worked, It successfully de-risked the banks.
They stopped doing the crazy hyper-leveraged lending that caused the subprime crisis.
Yeah.
They became, for the most part, safe.
Structurally safe, yes.
Yeah.
But safety for the banks just meant the financial system found a new home for all that risk.
Right. The risk didn't just vanish into thin air.
Precisely. That appetite for lending, the willingness to finance a risky corporate takeover or an indebted software startup, it just migrated. It shifted into these unregulated funds, totally outside the jurisdiction of federal banking oversight.
And this is so key for you to understand. If a regulated bank like a JP Morgan Chase or a Bank of America fails, the FDIC steps in. There's a safety net.
Mm-hmm.
If one of these giant private credit funds fails, there is no government backstop designed to catch it.
The potential failure point has been moved. It's been deliberately shifted from the insured banking system to the uninsured pension system.
It's the perfect illustration of that iceberg concept that several of our sources use.
Yeah, talk about that.
The small visible tip you see above the water is the public regulated banking system. It looks stable, it looks calm.
Right.
But the massive dark base lurking underwater, where the true hidden systemic risk resides, that's this $1.7 trillion private credit market. And today, we are diving into that dark base.
And we have to analyze the structure as being intentionally designed to be opaque, to be illiquid, and to be very, very difficult to regulate.
Okay, moving into part one, let's really explore this concept of the invisible lender and the specific trap it set. Contrast the experience for a, let's say, highly leveraged business seeking $200 million today.
Okay.
If they go to a traditional regulated bank, what happens? The loan officer is going to ask for massive, collateral, conservative cash flow projections, a business plan that fits these really rigid, capital-driven criteria.
And the answer is likely going to be no.
Exactly.
The traditional banks, they're focused on preserving capital, avoiding regulatory fines. They are slow, bureaucratic, and risk-averse. And frankly, that's a sign of a healthy, stable financial system.
But then that same business walks down the street, not to another bank, but to what our sources describe as a nondescript office building that houses a major private equity firm's lending arm.
And suddenly things change.
All of a sudden, they can get that $200 million in 48 hours. The process is streamlined, the scrutiny is minimal, and the only real cost is a handshake and a sky-high interest rate.
And that speed, that lack of scrutiny, that was the primary selling point of private credit for the last decade. During that whole era of near-zero interest rates, that post-2008 free money period, private credit became absolutely essential.
The grease in the wheels.
It was the financial lubricant that fueled nearly every leveraged buyout in the last 15 years. It financed the aggressive growth in tech, in certain pockets of commercial real estate development, and, the expansion of all those national chains that private equity owns.
Like the dental offices or the veterinary clinics you see everywhere now.
Exactly those. They were the only ones willing to provide that kind of risky leverage. And as long as rates were at zero, the model looked brilliant. It seemed resilient.
They could offer their own investors, like those pension funds we mentioned, an attractive yield, right? Maybe 7 to 9%, which was way better than safe bonds, while securing these massive management fees for themselves.
But that whole entire business model was predicated on one impossible assumption:
That interest rates would stay low forever.
that interest rates would remain perpetually low. And this takes us directly to the mechanical fault line of this whole system, the floating rate trap.
This is a critical concept, and we really need to dedicate some time to explaining how it works mechanically. What exactly is a floating rate loan in this market?
A floating rate means that the interest the borrower pays is not fixed for the term of the loan, say 5 or 7 years. Instead, it is pegged directly to a short-term financial benchmark. Usually, it's the Secured Overnight Financing Rate, or SOFR.
And SOFR itself, that tracks the rate at which banks borrow from each other overnight, which is heavily influenced by the Federal Reserve's main policy rate, the Fed funds rate.
That's right. So when you hear on the news that the Fed moved the Fed funds rate, SFR moves almost immediately.
So completely unlike a fixed-rate mortgage where your payment is locked in for 30 years, the borrower's interest expense on these private credit loans,
Yeah.
it's subject to instantaneous repricing.
Instantaneous. When rates were basically zero, a company with, say, a $500 million debt load might have been paying SOFR plus 4%, so maybe 4.5% total interest.
Which is expensive but manageable for a high-growth company.
Manageable. And the private credit funds, they loved this structure because it allowed them to constantly adjust their returns upward, creating this illusion of dynamic profitability.
But then in 2022, the game changed. The Federal Reserve started hiking rates aggressively to fight inflation, raising that benchmark rate from near zero to over 5%.
And the shift was, it was catastrophic, especially for companies that were already leveraged to their absolute limits. Suddenly, that $500 million borrower who was paying 4.5% is now paying SOFR plus 5 or 6%. With SOFR where it is now, around 5.3%, they're suddenly paying interest rates between 10.3 and 12, even 14% on the riskiest deals.
Their annual interest expense literally doubled or tripled.
Overnight.
Overnight.
I have to ask.
For any operating business, especially one that was already heavily leveraged, how can you possibly absorb a doubling of your core debt expense without any increase in revenue?
The simple answer is you can't. They can't. Our sources paint a really bleak picture of the result, a massive proliferation of what we now call zombie companies.
And what does that mean exactly?
These are firms that, economically speaking, should have already failed. They might generate enough revenue to keep the lights on and pay the staff, but they are bleeding cash just to service those massively inflated interest payments.
And we're not just talking about some obscure factories here. These are often recognizable leveraged entities, right?
Oh, absolutely. The consolidated dental or veterinary chains we mentioned, certain mid-level software providers, the network of quick-service restaurants that got acquired in a highly leveraged buyout, they are, for all intents and purposes, bankrupt on an economic level. But they continue to operate.
The financial stress must be immense.
It is. I mean, think about it. If your company's annual interest payment goes from $20 million to $45 million, that $25 million difference is money that can no longer be invested in operations or expansion or even just basic maintenance.
Your operating margins are being completely devoured by the debt.
Eaten alive. They are technically defaulting every single quarter, but they haven't collapsed yet because of a deeply manipulative accounting mechanism.
And that takes us to the truly shocking part of this whole forensic investigation. This is where it gets really interesting, as we uncover the specific trick used to prevent this floating rate disaster from becoming an immediate, visible crash.
The entire system is built on a massive fiction. We're moving into part 2, the shocking cover-up, and specifically the practice known as payment in kind, or PIK.
Okay, let's first establish the contrast with the regulated world. If one of these highly indebted borrowers tried to miss a cash interest payment to a public bank,
Right.
that bank would instantly have to classify the loan as non-performing. They'd be required to mark it as bad debt, which would force them to hold more capital against the loss. It reduces their profitability. It hammers their public stock price.
The market enforces discipline through transparency.
Exactly. But private credit funds operate in the darkness. They are these illiquid vehicles, insulated from daily public investor scrutiny. So when that zombie company, struggling with a 12% floating rate, calls the fund manager and says, "We don't have the cash to make the $45 million interest payment."
The private credit fund deploys this loophole.
And the loophole is PIK. Explain the mechanics of that instruction.
The lender basically tells the borrower, "We get it, you're stressed. We're not going to demand the cash payment right now. Instead, you can pay us the interest with more debt."
With more debt.
Yes. The missed interest payment isn't forgiven, it's capitalized. It's added directly to the outstanding principal of the loan.
Okay, let's use a simple numerical illustration because this is where the exponential risk really gets created. So a company owes $100 million. They miss a $10 million interest payment.
Okay.
The loan balance is now $110 million. They have paid their interest, not with cash they earned, but with an IOU for even more debt.
That's the first step. But here is the crucial, shocking accounting fiction that allows this crash to remain hidden. The private credit fund then records this PIK addition, that $10 million increase in principal, as income, as profit on their books for the quarter.
Wait, hold on, I have to stop you there. If no cash is moved, and the company is clearly so distressed it can't pay in cash, how can they legally record debt, which is a liability for the borrower, as revenue for the fund? Isn't that fundamentally fraudulent? I mean, where are the auditors in all this?
That is the most critical question. And it's what's so fascinating here. They justify it under something called fair value accounting in illiquid markets. They argue that the loan is still performing and that the value of the loan has increased by the amount of that accrued interest.
So they claim they'll eventually get the cash when the loan matures down the road.
Precisely. So the private credit fund gets to report a profit, boosting the returns they show to their own investors, despite the underlying reality that their borrower is in deep, deep distress. They are literally lending the borrower money to pay themselves the interest they are due and then calling that lending a profit.
It's circular finance at its most audacious. It ensures the borrower is buried deeper and deeper in debt. But the private credit fund's quarterly returns look incredibly stable and attractive.
Especially to their primary investors, like the pension funds, who are desperate for that kind of low volatility.
This is the very definition of extend and pretend.
It is. It keeps the loan from being classified as non-performing, which completely hides the actual default rate across this entire $1.7 trillion market. It sustains a market fiction, making the system appear vibrant and healthy when, based on the actual economics of the borrowers, it is rotting from the inside.
And as we pointed out in our little example, the problem just accelerates, right? If the principal jumps from $100 million to $110 million.
Right.
The next interest payment, which is still calculated at that 12% floating rate, is now based on $110 million, not $100 million.
So that next payment will be even higher, forcing the borrower into an even deeper PI hole, requiring an even larger amount of new debt to pay the interest.
It creates this completely unsustainable feedback loop. It's a Ponzi scheme of debt compounding on top of debt.
And the structure only works as long as the funds can keep rolling the principal and adding that P interest, never actually demanding cash. But eventually, someone has to pay. Someone has to pay the actual cash interest or, more importantly, the entire principal when the loan matures.
And all this debt, this entire mountain built on the fiction of PI counting, it has to be secured by something,
It does.
which leads us directly to the next massive fault line in this crisis, which is the collateral. We move now to part 3, the collateral and the refinancing wall.
So the question is, what is backing this gargantuan pile of debt? In a huge portion of the private credit market, the loans are secured by commercial real estate, CRE.
So we're talking about secondary office towers, B and C class malls, industrial properties, hotels, all financed aggressively during the peak valuation years.
All of the above.
And the high-level facts about the CRE market are, they're universally known at this
They
rate.
are.
Structural shifts. Chiefly the permanent move to remote or hybrid work have just devastated the demand for office space. E-commerce has completely undercut the viability of many retail centers.
In valuations across these sectors, our sources estimate they're down 30 to 40%, maybe even more for the really distressed properties from their 2019 peaks.
So what we have here is a catastrophic convergence of factors.
It's a toxic trifecta, truly.
You have loan principals that are ballooning because of PYK, you have interest rates that are crippling the borrowers because they're floating, and now the value of the assets securing those loans has plummeted.
So if the collateral for a $100 million loan is now only worth $60 million, the private credit fund should be forced to mark down the value of that loan on its own books to reflect that potential loss.
But our investigation reveals what you could call a valuation standoff. The funds have, for the most part, refused to recognize these losses. Why?
They are, and this is a quote, still valuing these buildings at 2019 prices. And this refusal, it's a mechanism of self-preservation. It's driven by their own investor base.
How so?
If a private credit fund were to mark down the value of its underlying assets, the collateral, it would trigger what are known as margin calls on its own investors.
Okay, let's elaborate on the mechanism of a margin call in this institutional context. We're talking about huge pension funds here, not, some individual day trader.
Correct. Pension funds and insurance companies, they invest in these private credit funds, and they often use borrowed capital, or they have to adhere to very strict internal allocation limits based on the reported net asset value, or NAV, of that investment.
Okay.
So if the private credit fund suddenly slashes its reported NAV because it correctly marked down the value of some office building from 100 million to 60 million, the pension fund's ratio of debt to equity in that investment might breach a covenant.
Meaning the pension fund would have to immediately post more cash with the private credit fund to meet that margin call, or risk being forced to sell at a huge loss.
Exactly. And the fund managers know that if they force hundreds of pension funds and insurance companies to post new capital all at the same time, it would trigger a systemic liquidity crisis among those very investors.
So they just choose to maintain the fiction of high valuations to prevent an investor run today.
They're hiding the losses from their own sophisticated investors to avoid causing an immediate panic.
This connects all the dots. It's all about deferring the day of reckoning. The fund managers are using PKK to hide the inability of the borrower to pay, and they're using fictional peak valuations to hide the fact that their collateral is worth a fraction of the loan.
But that day of reckoning, it has a specific deadline. It's called the refinancing wall. And our sources are unanimous in pointing to 2026 as the critical period.
Why then?
Billions, maybe hundreds of billions of dollars of these specific private credit loans, which are often structured as 5 to 7 year terms, they're all set to mature simultaneously in 2026.
So these zombie companies, which can't even afford the interest payment and are paying with more debt, will suddenly be required to pay back the entire principal. A balloon payment that is now even larger than what they originally borrowed because of PIK.
It is mathematically impossible. They cannot pay the principal, and they certainly cannot refinance the loan at current interest rates of 12% or more.
Especially since any new lender would immediately realize the office tower securing the loan is now worth half the loan amount.
Right.
So what happens when the loan matures and the borrower officially defaults?
The outcome is inevitable, and it's messy. The borrowers will default en masse. The keys to these over-leveraged assets, the half-empty office buildings, the struggling malls, they will be mailed back to the private credit funds who suddenly become the owners.
The shadow banks will transform into America's largest, most unwilling slumlords.
Exactly, forced to manage and liquidate all this devalued commercial real estate in a depressed market. The losses will stop being a fiction on a spreadsheet and will become cold, hard reality on their books.
This entire forensic exercise so far, it's focused on the mechanics of the bubble itself.
Ah.
But now we have to pivot to the impact. And this is perhaps the most important realization for you listening. Who ultimately holds the bag?
Yes.
Part 4 is the pension fund contagion, the systemic transfer of risk onto everyday retirees.
This is the crucial point that challenges that common assumption, I don't own a private equity firm, so I'm safe. The reality is that the structural changes after 2008 ensured that you, the individual taxpayer or retiree, are now the ultimate backstop.
So who exactly are the primary investors pouring trillions into these illiquid, unregulated funds and in doing so, financing this whole PI scheme?
The investors are overwhelmingly the large institutional pools of capital that are mandated to guarantee future payouts. We're talking state and municipal pension funds, large insurance companies that back your annuities and life policies, and massive university endowments.
So this is your retirement security, your kids' education funds,
Yeah,
your future healthcare payment.
it is.
But why? Why did these highly conservative, traditionally risk-averse institutions dive headfirst into the riskiest, most opaque debt market in the world?
It was a decade-long search for yield. Pension funds are structurally required to achieve high annual returns. They often target 7 or 7.5% just to meet their future obligations to current workers and retirees.
And when safe assets, like U.S. Treasury bonds, were yielding 0.5% or 1%,
They were mathematically doomed to fail unless they embraced risk.
and private credit was marketed as the perfect solution to their dilemma.
It was sold as a secret weapon.
Huh.
Private credit funds promised steady, high returns and, most critically, low volatility.
Oh, there it is, the low volatility.
And they could make this promise because of the very accounting mechanisms we just discussed, since they don't mark their assets to market every day, and since they can use PIK to turn defaults into reported income.
The reported returns look incredibly smooth,
Mm.
consistent, uncorrelated with the wild swings of the public stock market.
And that illusion of stability was exactly what these institutional investors needed to see to justify hitting their 7% return targets.
So the financial system effectively took the most volatile, toxic floating rate debt risk, the kind that regulated banks were forced to get rid of, and they repackaged it. They put a new label on it that said low volatility bond substitute,
Yeah.
and sold it directly to the most risk-averse institutions in the country.
That is the definitive structure of the systemic transfer of risk. The failure point was explicitly shifted from the banks, which have FDIC guarantees and a clear government safety net, to the pensions, which are liabilities backed by the solvency of the fund itself, or, at the end of the day, taxpayer-funded municipal budgets.
Let's detail the personal impact then. When that refinancing wall hits in 2026, and those massive hidden losses finally have to be recognized on the books of the private credit funds, how will that manifest for the everyday retiree? We're talking about a silent pension freeze.
Right. And this won't look like a dramatic bank run you see on TV. There won't be lines outside a building. It's going to be slow and painful and deeply personal. When the pension fund is forced to absorb billions in write-downs from their alternative investment bucket, the financial projections for that fund will instantly collapse.
What happens then?
Well, you might receive a letter from your state or your corporate pension plan. And that letter informs you that, due to unanticipated losses, your projected retirement payouts are being reduced by 10 or 15%.
Wow.
Or, if you're still working, your required annual contribution to meet the fund's obligations might suddenly double. If the losses hit major insurance companies that back annuities, those companies might be forced to raise premiums drastically across the board to cover their catastrophic losses.
The ripple effect is just severe. It's a generational impact.
It is.
The banks are safe, thanks to the post-2008 reforms. But the retirees, whose money financed this entire shadow system, are now the ones holding a hollowed-out fund filled with devalued real estate and PIK debt.
The profits were privatized by the fund managers, but the risk has been thoroughly socialized onto the public retirement infrastructure.
And this situation creates an immediate and incredibly complex ethical dilemma for policymakers.
It does, which is the basis of our final section.
That brings us to part 5, the verdict and the government bailout dilemma. Before we even get into the policy debate, we have to address the immediate mechanical crisis that will come first, the liquidity crisis.
We've established that private credit is an illiquid asset class. Unlike a public stock or bond, you cannot just sell your share of a distressed loan portfolio instantly. The loans are locked up for years.
So when the panic inevitably starts, when the pension funds finally realize their low volatility returns were an accounting fiction and that their collateral is failing, they will all rush to withdraw their money at the same time.
And the private credit funds simply cannot meet those redemption requests. They don't have the cash. They hold long-term, illiquid loans to zombie companies. This is when they implement the infamous gates.
The gates, meaning the fund freezes or strictly limits withdrawals, trapping investor capital inside.
Exactly. We saw a high-profile warning shot with Blackstone's real estate vehicle, Bright, back in 2023. They had to limit redemptions when faced with investor panic.
Right, I remember that.
The forecast for 2026, when that refinancing wall hits and defaults become impossible to hide, is that the gates will slam shut everywhere. This will trap the capital of countless pension funds, endowments, and insurance firms inside these distressed assets for years. The moment those gates slam shut, the true losses will crystallize, and that's what sets the stage for the political intervention debate.
Okay, so let's frame the ethical and policy dilemma. You have these private equity firms who took massive risks. They made risky loans, and they earned billions in management fees and carry from this extend and pretend structure. If they fail, the pure capitalistic argument says they and their sophisticated investors should bear the losses.
Right.
But they hold the retirement money of ordinary Americans. Should the government intervene?
This raises an important question that policy leaders, likely facing a widespread economic freeze, will have to struggle with. Let's look at the arguments for intervention first, based on prioritizing societal stability.
Okay, what's the case for a bailout?
The primary argument is just preventing societal collapse. A failure of the largest private credit firms or the simultaneous insolvency of multiple state and corporate pension systems could trigger a widespread economic depression. It could collapse consumer confidence, potentially even the insurance sector, which relies on these assets.
The government's argument wouldn't be framed as saving the financiers.
No, never. It would be framed as saving the millions of retirees who were innocently invested through their pension plans. They'd argue the contagion risk, the spread of illiquidity and insolvency into the retirement system, is simply too great to ignore.
So they might authorize some novel, costly liquidity facilities similar to the bank backstops to allow the funds to keep operating and prevent that pension freeze.
Using the retirees as a human shield, essentially. Arguing that saving the pension system requires rescuing the shadow banks that created the crisis in the first place.
Okay, so what about the other side? The arguments against intervention.
Those are rooted firmly in preventing moral hazard. Bailing out these shadow banks rewards reckless, unregulated behavior. It would send a clear, damaging message to the financial world.
What message is that?
That you can engage in excessive risk-taking, use creative accounting like PIK to hide your losses, and if it all goes wrong, don't worry. The taxpayer will bail you out because you cleverly placed ordinary people's pensions at the center of your risk structure.
The argument is that the smart money that operated outside the regulated system to avoid oversight must now accept the consequences of its own actions. Otherwise, we're just inviting a larger, more egregious crisis in the future.
It's a tragic political catch-22. The solution, regardless of which choice they make, will be economically painful and politically radioactive.
And we should emphasize that the government's traditional toolkits, like the TARP program from 2008, they were designed to inject capital into publicly traded banks.
Right.
Since the risk is now external to that system, it's in illiquid private credit funds and pension systems, the required solution will have to be new, expensive, and potentially lack a clear legal precedent.
A whole can of worms.
Okay, that brings us to our conclusion. Let's summarize the key takeaways from this forensic deep dive into the hidden crash.
The file on the private credit bubble, it really reveals a system that is leaking danger from three interconnected factors. First, the instantaneous doubling of debt costs caused by that floating rate trap. Second, the hidden losses being masked by the accounting fiction of payment in kind, or PIK. And third, the collapsing value of the commercial real estate collateral that's supposed to be backing it all up.
And for you, the individual listener, the immediate warning here is all about liquidity. When those gates slam shut, which our sources suggest is highly likely in 2026, cash will be king. Opportunities to buy distressed assets will eventually emerge when those keys get mailed back to the shadow banks, but only for those who are liquid and can actually access their funds.
I think the most actionable knowledge here is the personal audit. You really must audit your retirement accounts, your 401k, your pension statements, any managed fund you have. Look for exposure to terms like alternative investments, non-traditional debt, or private credit.
Don't just accept vague descriptions. You need to demand transparency from your financial advisor or your fund manager about the specific percentage and the nature of these illiquid holdings.
And finally, a very clear warning against chasing high returns. You can now get 5% safely in short-term government debt.
Right. Risk-free.
If an illiquid private credit fund is still touting some unbelievable 10 or 12% projected yield in this slow economic environment, that is not a sign of genius investing. It is an absolute certainty that they are taking massive risk and using mechanisms like PIK to report that return.
Do not let the pursuit of an extra couple of percentage points destroy your entire retirement security.
The investigation file is now closed, but the crisis is unfolding silently. The smart money is already moving to the exit. They're lightening their exposure and maximizing their liquidity ahead of that 2026 maturity wall.
As we conclude, here is a final provocative thought for you to consider, building on everything we've uncovered about the structure of risk in this shadow system.
If regulated banks whose entire business is assessing and managing risk explicitly refuse to lend to a specific company, and that company is now paying an astronomical 12% interest rate, why would you, the individual, decide that this is the appropriate borrower to trust with your decades of retirement savings? When you fully understand the illiquidity and the accounting fictions involved, is that small incremental reward truly worth the potential collapse of your fundamental financial security? That is the core question hanging over the private credit bubble.